Hey, it's Alani from the William Factory. Happy Friday. What does financial success look like for you and your business? Let's map out your journey to financial freedom. Today, in What's Your Financial Future? Charting Pathway to Success, you'll learn how to set smart goals, create an action plan, and overcome barriers. This is the 9th of 10th weekly trading sessions in our Business Finance series. Now, let's get started. For our table of contents, we have identified business financial goals, create a pathway to achieve financial success, and plan for financial uncertainties and overcoming barriers. Now, let's get on to identify business financial goals. Let's talk about what are financial goals. A financial goal is scientifically defined financial milestone that you plan to achieve or reach. Financial goals comprise earning, and that you might need to increase your income to reach a particular goal. Savings, that's how many goals require setting aside a proportion of your income regularly. Investing, and that's for longer term goals, you might need to grow your money through investments. Spending, and that's like even your spending habits are affected as you might need to cut back in certain areas to free up money for your goals. And in proportion that matches short terms, medium terms, or long term plans. Every financial goals will have three details associated with them, and that's what is the purpose? That's why do you want to achieve this goal? What will it allow you to do or have? Understanding the why keeps you motivated. Get an example to have a comfortable retirement, to buy a home for my family, or to travel the world. You want to talk about how much money is needed, and that's like a quantitative aspect. You need to put a specific dollar figure on your goal. Example, $1,000 for a new laptop, $50,000 on a down payment, $1 million for retirement. And last thing would be how much time. And that's like usually in years. This is a deadline for your goal, knowing the time frame helps you determine how much you need to save or invest regularly. Example, within 6 months, in 5 years, or by age of 65. And since this slide is laying the foundation for understanding the financial goals, are not just abstract desires, but rather concrete plans with a clear purpose, a defined cost, and a specific timeline. Having well defined financial goals is the first step towards taking control of your finance and building the future of your vision. This slide elaborates on the different time frames for financial goals, categorizes them into short terms, intermediate, and long terms. It also provides examples of goals that typically fall under each category. Let's break it down. For the short term financial goals, this slide indicates that short term goals are those that take less than 3 months to achieve. These are your immediate financial priorities. The slide gives an example of building up an emergency fund and start a small side hustle. Building an emergency fund, this is a classic short term goal. The aim is to quickly save a small amount of money that's like often $500 or $1,000 initially to cover unexpected expenses like a car repair or a medical bill. The urgency often places it within a short time frame. Starting a small side hustle, while the long term success of a side hustle might take time, the initial step of brainstorming ideas, setting up a basic service, or selling a few items can often be done within a few months. The goal here is the initiative of a side hustle. To give you key characteristics of a short-term goals, high liquidity, that these are goals often involve needing access to the money relatively quickly, lower risk, the focus is usually on preserving capital rather than significant growth, and provide financial security and flexibility that achieving short-term goals can reduce immediate financial stress. On to intermediate financial goals, and these intermediate goals are defined as those that take 3 to 12 months to achieve. These are goals that require a bit more planning and consistent efforts over a slightly longer period. This slide provides two examples: paying off all your credit card debt and starting investing 20% of your home. Paying off all your credit card debt, that's depending on the amount of debit. This can be realistically take several months to focus repayments. It requires budgeting, potentially cutting expenses, and consistently making payments. Starting 20% of your home, this example is a bit ambitious. It's likely means starting to save or allocate funds equivalent to 20% of your value you to aim to invest in your home, perhaps for renovation, a larger down payment, or a future home or building equity. Accumulating a significant amount like 20% of a home value would typically be a larger term goal. However, the initial step of starting the process of allocating funds towards this within a 3 to 12 months time frame could be considered a intermediate goal. The key characteristics of intermediate goals that require more discipline that achieve these goals need sustained efforts and commitments. We got balanced liquidity and growth that you might still need some accessibility to the funds, but there also be a element of growth involved that's through initial small investments and build momentum that successfully achieve intermediate goals can provide motivation for longer term plans. On to the last one of three types of financial goals we have is long-term financial goals. Long-term goals are those that take more than 12 months to achieve. These are your major life financial aspirations that require significant planning and time to realize. This slide gives an example of earn enough from your side hustle to cover all your expenses, and that this is a significant financial milestone that would typically take more than a year to achieve. It involves growing the side hustle, potentially scaling operations, building a consecutive income streams, and ensuring that income consistently meets or exceeds all living expenses. The key characteristics of long term goals we have require significant planning and patience, and that these goals demand a long term perspective and consistent effort over many years. Focus on growth, that's long term goals, often involve investments and strategies aimed at maximizing returns over time and leads to major life changes and financial freedom that's achieving long term goals can provide significant financial security and enable major life choices. In summary, this slide effectively illustrates that financial goals exist on a spectrum of time. Recognizing whether a goal is short term, intermediate, or long term is crucial for prioritizations, and that it helps you decide which goals need immediate attention and which can be planned for the future. Strategy, this time frame influences the financial strategies you employ. That's like high yield savings for short term versus stock market investments for long term. And motivation, that's breaking down larger long term goals into smaller, more achievable short terms and intermediate steps can keep you motivated along the way. By understanding these different time horizons, you can create a comprehensive financial plan that addresses your immediate needs while also working towards your bigger life aspiration. This slide focuses on the crucial first step in financial planning for a business, assessing its current financial situations. It emphasizes the need to have a clear and accurate understanding of where the business stands financially before setting goals or make strategic decisions. This core action highlights is to analyze income, expenses, assets, and liabilities. Let's break it down each component. For the analyzed income expenses, it conducts a thorough review of monthly income sources, such as sales revenue or service fees. And this involves identifying all the ways the business generate money. This could include sales revenue, service fee, in- interest income, other incomes, and comparing them to recurring expenses like rent, utilities, and payrolls. This step involves identifying all the regular costs the business incurs to operate. This typically includes rent, utilities, payrolls, supplies, marketing and advertising, insurance, loan payments, and other recurring expenses. The goal of analyzing income and expenses is by comparing income expenses, a business can determine its profitability. If income exceeds expenses, the business is generating a profit. Analyzing the margin, that's the difference between income and expenses, It's crucial to understand how effectively the business is operating. If expenses exceeds income, the business is operating at a loss. Identify areas where expenses can be reduced or income can be increased becomes critical for sustainability. This analysis often involve creating an income statement or profit and loss statements which summarizes revenue, costs, and expenses over a specific period that's monthly, quarterly, or annually. For the comply a list of assets and liabilities. This includes cash reserve, inventory, equipment, and investments. Assets are what the business owns that have economic value, and that can include, cash reserves, inventory, equipment, building and land, accounts receivable, investments, and intangible assets. And subtract liabilities such as outstanding loans and accounts payable to calculate net worth. Liabilities are what the business owes to others. This can include, outstanding loans, account payable, salaries payable, tax payable, and deferred revenue. The goal of analyzing assets and liabilities, understanding a business assets and liabilities provide insights into its financial health and stability. The positive net worth, it indicates that the business owes more than it owes, which is generally a healthy sign. If is a negative net worth, suggests that the business owes more than it owns, which can be a sign of financial distress. This analysis often involves creating a balance sheet or statements of financial positions, which provides a snapshot of company assets, liabilities, and equity at a specific point of time. In conclusion, this slide emphasizes that a thorough and accurate assessment of a business income, expenses, assets, and liabilities is a fundamental prerequisite for sound financial state management and strategic planning. It provides the necessary foundation of setting financial goals and making informed decisions that will contribute to a long term success of the business. This slide builds upon the previous one, which is focused on analyzing the raw financial data. This slide emphasizes the crucial next step, which is identifying the strengths and weaknesses revealing by the analysis. Understanding these strengths and weaknesses is vital for making informed financial decisions and developing effective strategies. Let's talk about identifying strengths, which is recognize areas of financial strength, such as consistent revenue streams or low overhead costs that contribute positively to the business financial health. This involves looking at the data you collected and pinpoint aspects what that are working well for the business. Example of financial strength includes consistent revenue streams. That's like having a reliable and predictable source of income, whether from diverse customers, recurring contracts, or multiple product lines. This provides stability and reduces reliance on unpredictable sales. We have low overhead costs, that's keeping fixed expenses at a minimum. This increased profitability because more revenues flows directly to the bottom line. We also have high profit margin that's selling products or service at a price significantly higher than its cost, leading to greater profitability per sale. We got strong cash flow that's having a healthy and consistent inflows of cash that exceeds outflows, allowing the business to meet its short-term obligations and invest in growth. You also want to have low debt levels that's having minimal outstanding loans or other liabilities, which reduces interest expenses and financial risk. We got valuable assets that's owning assets that are appreciating its value or generating significant returns. Strong customer loyalty, having a base of repeat customers who consistently purchase goods or service, providing reliable source of revenue, and efficient operation that streamline processes that minimize waste and maximize productivity, leading to lower costs and higher efficiency. Why is identifying strength important? That's because leveraging advantages, knowing your strengths, allows you to capitalize on them. You can focus on activities that are already successful and potentially expand in those areas. Building confidence that's recognizing financial strength can boost morale and provide a sense of stability. Attracting investments that strong financial indicators make the business more attractive to potential investors or lenders. And competitive advantage that's financial strength can provide a significant edge over competitors. Now, on to identifying weaknesses, and that's like acknowledge weaknesses such as excessive debt, cash flow fluctuations, or reliance on a single revenue sources that may possess risk to financial stability. And this involves identifying areas where the business is vulnerable and underperforming financially. Examples for financial weaknesses include excessive debt, that's like high levels of outstanding loans that lead to significant interest payments and restrict cash flow. It also increases the risk of financial distress if revenues declines. Another example would be cash inflow fluctuations, that's consistent or unpredictable cash inflows, making it difficult to meet short-term obligations and plans for the future. This can be caused by seasonal sales, slow paying customers, or large infrequent expenses. You also have reliance on single revenue sources that's over dependent on one major customer, product, or service. If that source is lost or declines, the business financial stability is severely threatened. You also got high operating costs, that's inefficient processes or executive spending on overhead, reducing profitability, low profit margin, that's selling products or service with minimal profit, making the business vulnerable to cost increases or price competition competition. We got obsolete and inefficient assets that's using outdated equipment or having underutilized assets that don't generate sufficient returns. Poor inventory management that's holding too much inventory, like tying up cash, or too little inventory leading to lost sales. And weak credit terms that's offering overly generous credit terms to customers leading to slow payments and cash flow problems. Why identifying weaknesses important, which is mitigating risks, that's recognizing weaknesses allows you to take proactive steps to address them and reduce potential negative impact on a business. Another thing would be improve performances. That's identifying areas for improvement can lead to increased efficiency, profitability, and stability. Strategic planning, that's understanding weaknesses, help to developing strategies to diversify revenue, reduce costs, manage debt, and improve cash flow. And attracting investments, that's with a plan. While weaknesses might be a concern for investors, having a clear understanding of them and a plan to address them can actually be a positive sign of management awareness and proactively. In summary, sure, this slide highlights that simply analyzing the numbers isn't enough. A crucial part of assessing the current business financial situation is to interpret the data to identify the underlying strengths that can be leveraged and the weaknesses that need to be addressed. This honest and critical self assessment form the foundation of setting realistic financial goals and developing effective strategies to improve the business financial health and long-term sustainability. It's un- it's about understanding not just what the numbers are, but what they are mean for the future of the business. This slide focuses on the tools that businesses can use to effectively assess their current financial situations. It emphasizes the importance of leveraging established financial documents and forecasts to gain a comprehensive understanding of their financial health. The key takeaway is to use tools like balance sheets, income statements, and cash flow projections. Let's delve into these tools. Let's talk about the balance sheet. It's utilized financial statements like balance sheets to track assets, liabilities, and equity, providing a snapshot of a business financial position at a specific point in time. And what it is, the balance sheet is like a photograph of a company's financial standing at a particular moment. How it helps assess the current situation, which is one, liquidity, that's by examining current assets, those easily convert into cash, and current liabilities, those due within a year. You can assess the company's ability to meet its short term obligations. Second, we have solvency. That's by looking at total assets and total liabilities. You can evaluate the company's long term ability to meet its financial obligations. A high level of debt relative to equity might indicate higher financial risk. Third, we have is capital structure. That's the balance sheet reveals the mix of debt and equity used to finance the company's asset. It is important to understand financial risk and leverage. And last of, of it would be assess efficiency. That's by comparing assets value to revenue, you can get an idea of how effectively the company is using to assets to generate sales. Now, onto the income statements, that's profit and loss statements. Income statements can help assess profitability by comparing revenue against expenses over a defined period. What it is, the income statement summarizes a company's financial performance over a specific period. That's month, quarter, or year. It shows the revenues earned and the expenses incurred to generate these revenues, ultimately arriving at the net profit or loss. How it helps assess the current situation: one, profitability. The income statement directly shows whether the business is making a profit or a loss and the magnitude of the profit or loss. Second, revenue trends. That's by comparing income statements over different periods, you can identify trends in sales growth or decline. Third, expense management, that it allows you to analyze different categories of expenses and identify areas where costs might be too high or can be reduced. Fourth, we have efficiencies. That's by looking at the cost of goods sold and operating expenses as a percentage of revenue. You can assess how effectively the business is managing its costs. And last would be gross profit margin and net profit margin. And these ratios provide insights into the profitability of the company's core operations and its overall profitability after all expenses. Now, let's talk about cash flow protections. While cash flow protection forecasts future cash inflows and outflows to anticipate liquidity needs. And what it is, a cash flow protection is a forecast of the money expected to come into the business, that's inflows, and the money expected to go out, that's outflows, over a future period, that's weekly, monthly, quarterly, is distinct from the income statement, which can include non cash items like depreciations. Cash flow focuses on the actual movement of cash. The key components, which is cash inflows, money comes into the business from sales, collections from customers, loans, investments, etc. Cash outflows, that's money leaving the business for payments to suppliers, salaries, rent, utilities, loan payments, taxes, etc. The net cash flow, that's the difference between total cash inflows and total cash outflows. And we got beginning and ending cash flow balance, that's tracking the cash balance at the start and the end of each protection period. How it helps assess the current situation and anticipate the future. One, liquidity assessment. While a balance sheet provides a snapshot, cash flow projection helps understand the timing of cash inflows and outflows, revealing potential short term cash storage and surpluses. Understanding the current cash flow patterns is crucial for creating accurate projections. We got working capital management. That's by anticipating cash needs, businesses can better manage their working capital, the difference between current assets and current liabilities, to ensure they have enough liquid funds to operate smoothly. Now, to the third one, we have investment and financing decisions. That's cash flow projections help determine if the business will have enough cash to fund planned investment or if additional financing will be required. And last will be early warning system. That's significant negative cash flow projections can signal potential financial difficulties that need to be addressed proactively. This slide emphasizes a thorough assessment of a current financial state situations require more than just a casual look at the bank balance. It's necessities of systematic use of key financial tools. And that's the balance sheet provides a snapshot of what the business owns and owes at the specific point in time. The income statement reveals the business profitability over a period, and cash flow protection, while forward looking, are based on current operational trends and help anticipate future liquidity needs, which is directly linked to the current financial health. By utilizing these tools, Businesses can gain a much deeper and more accurate understanding of their financial strength, weaknesses, and overall financial health, laying a solid foundation for informed decision making and strategic planning. This slide illustrates the SMART framework of setting effective goals. While the slide mentions agency revenue growth under the relevant section, the SMART framework is universally applicable to setting any kind of goal, including those related to a business financial future. Let's break down each element of SMART in a context of business financial goals. Let's start off with the S, which stands for specific. And what that means is, what exactly are you trying to achieve? A specific financial goal is well defined, clear, and unambiguous. It, it answers the what, why, who, where, and how of the goal. In the context of the business financial future, instead of saying increase profit, a specific financial goal would be increase net profit margin by 5% within the next fiscal year. This clearly states what you want to achieve, increase net profit margin, the amount, the 5%, and the time frame, the next fiscal year. Other examples like include increase monthly recurring revenue by $10,000 by the end of the third quarter of 2025. We got reduce operating expenses by 8% over the next 6 months. Another example, achieve a debt to equity ratio of zero point 0.5 by the end of 2026, or generate $50,000 in revenue from from a new product line within the first year of its launch. We have M, which stands for measurable. And what it means, how will you know when you achieved it? A measurable goal is quantifiable criteria for success. You need to be able to track progress and determine when the goal has been reached. In context of a business financial future, the example above are clearly measurable because they are include specific numbers, 5%, $10,000, 8%, zero point 0.5, and $50,000, and the time frames. Without a measurable component, it's impossible to know if you're making a progress or when you've succeeded. For instance, improved cash flow is not measurable, but increased free cash flow by 15% year over year is. You can track your net profit margin, MRR, operating expenses, debt to equity ratio, and new product revenue to see if you're on track. Now we have the A, and that stands for attainable. And that means, is it genuinely possible to achieve it? An attainable goal is challenging but realistic given your business resources, capabilities, and market conditions. It shouldn't be so easy that it doesn't push you, nor so difficult that it's demotivating. In the context of business financial future, when setting financial goals, consider your current financial performance, industry benchmarks, available resources, and potential market opportunities and threats. To give it, for example, aiming to double revenue in a stagnant market with limited resources might not be attainable. However, a more realistic goal like increasing revenue by 10% through target marketing and sales efforts might be achievable. It's important to conduct thorough market research and internal assessment to ensure your financial goals are ambitious yet within reach. Now, heading to R, which stands for relevant, and what it means that what does it contribute to your agency's or business revenue growth? A relevant goal aligns with your business overall strategic objectives, visions, and missions. It should make sense in a broader context of where you want your business to go. In the context of the business financial futures, financial goals should directly support the long term success and sustainability of the business. To give a few examples, increasing net profit margin is relevant to improving overall profitability and financial health. Growing MRR is relevant for business with a subscription model, contributing to predictable and recurring income. Reducing operating expenses is relevant to improving efficiencies and increasing profitability. Achieving a target debt to equity ratio might be relevant to reducing financial risk and improving the company's balance sheet. Or generating revenue from new product is relevant for diversification and future growth, ensures that the financial goals you set are not isolated metrics, but rather contribute to the bigger picture of your business financial well-being and strategic direction. On to the last letter we have is T, that stands for time bound, and what it means: when do you want to achieve this by? A time bound goal has a specific deadline or time frame for completion. This creates a sense of urgencies and help you stay focused and accountable. In the context of business finance future, each financial goal should have a clear start and end date. This allows you to track progress over time and make necessary adjustments if you're falling behind. To give you a few examples include increase net profit margin by 5% by the end of the next fiscal year, reduce operating expenses by 8% over the next 6 months, achieve a debt to equity ratio of zero point 0.5 by the end of 2026, or generate $50,000 in revenue from the new product line within the first year of its launch. Why is the SMART framework important for future financial future? Well, using the SMART framework for setting financial goals provide numerous benefits. One, clarity and focus. It forces you to define exactly what you want to achieve financially. Two, trackable progress. That's measurable goals allows you to monitor your performance and identify if you're on track. Three, increased motivation. That's achievable goals keep the team motivated as progress is made. Four, strategic alignment. That's relevant goals ensure that financial efforts contribute to the overall business strategy. Five, accountability. That's time bound goals create a sense of urgency and responsibility for achieving them. Six, better resources allocation. That's clear goals helps in allocating resources effectively to achieve the desired financial outcomes. And seventh, improve decision making. That's understanding your financial targets, inform strategic and operational decisions. By applying the SMART framework to your business financial futures, you can move beyond vague aspiration and create actionable, measurable, and achievable plans that drive financial success and sustainability. Now on to create a pathway to achieve financial success. This slide outlines 4 key steps to creating a comprehensive business financial plan. A well-structured financial plan is crucial for guiding a business financial decisions, securing fundings, and tracking progress towards its goals. So let's break down each of these steps in detail. Step 1, create a strategic plan. What it involves: before diving into the numbers, you need a clear roadmap of your business. A strategic plan defines your business mission, vision, values, target markets, products or service, competitive advantages, and overall long term goals. It outlines where you want your business to go and how you plan to get there. Why is the first step for a financial plan? Your financial plan is essentially the financial representation of your strategic plan. It puts numbers to your strategic objectives without a clear understanding of your business strategy. It's impossible to create meaningful and aligned financial projections and plans. Key elements of a strategic plan that influences the financial plan would be sales and marketing strategy. That's how will you attract and retain customers? What are your pricing strategies? What are your sales target? These will dive your revenue projections. Another key element will be operation plan. How will you produce and deliver your products or service? What are your operational costs? This will influence your cost of goods sold and operating expense projections. Management teams and organizational structure. Who are the key personnel? What are their salaries and benefits? This will impact your payroll expenses. Growth strategy. Are you planning to expand into new markets, launch new products, or acquire other businesses? This initiatives will require capital investment. And last, funding strategy. How will you finance your operations and growth? Will you use debt, equity, and internal funds? This will impact your financing costs and equity structure. On step two, we have create financial projections. What it involves, this step involves translating your strategic plan into financial forecasts. You'll develop estimate for your future revenues, expenses, profits, cash flow, and balance sheet items over a specific period that's typically 1 to 5 years, with more details in the initial years. The key financial projections to create would be sales forecast that's projecting your expected sales revenue based on your sales, and marketing strategies, market analysis, and historical data. If available, expense budget that's forecasting your operating expenses, including salaries, rent, utilities, marketing, administrative costs, etc. Cost of goods sold projection that's estimating the direct costs associated with producing your goods or services. Income statements that's projected combine your revenues, COGS, and expense projections to forecast your profitability, that's gross profit, operating profit, and net profit. We also have cash flow projection that's forecasting the movement of cash into and out of your business. This is crucial for managing liquidity and ensuring you have enough cash to meet your obligations. And last would be balance sheet projected, estimating your future assets, liabilities, and equity positions. As to why it's crucial, financial projection helps you assess the financial viability of your business strategy, identify potential funding needs, set financial targets and benchmarks, anticipate potential cash flow problems, evaluate the impact of different business decisions, and communicate your financial expectations to stakeholders. On to step three, we have planned for contingencies. As in what it involves, this step focuses on identifying potential risks and developing backup plans to mitigate their impact on your business financial health. It's about asking what if and preparing for unexpected events. To give an example, let's say economic downturn, which is a recession or slowdown in the economy could reduce customers' demand. Increase competition, new entrants, or aggressive actions from existing competitors could impact market shares and pricing. Supply chain disruptions. Issue with suppliers could lead to production delays and increased costs. Unexpected expenses, that's equipment breakdowns, legal issues, or unforeseen market changes, can create unexpected costs. Loss of a major customer, that's if a significant portion of your revenue comes from one client, their departure could have a major impact. And the last example, changes in regulation, that's like new laws or regulations could increase compliance costs. Let's talk about the strategies for it, which is building cash reserve, that's having a buffer of cash to weather financial storms. Diversifying revenue streams, that's reducing reliance on a single product, service, or customer. Developing alternative supplier, that's ensuring you have a backup options if your primary suppliers faces issues. Now we have insurance coverage, that's protecting your business against potential losses. Contingency budget, that sets aside funds for unexpected expenses. And developing crisis communication plans, that's preparing how you will respond to negative events. As to why it's important is planning for contingencies can help your business survive unexpected challenges and maintain financial stability. It demonstrates foresight and responsible management. On to the last step, we have step four, monitor and compare goals. What it involves, this is an ongoing process of tracking your actual financial performance against the projections and goals outlined in your financial plan. You need to regularly review your financial statements and compare the actual results to your forecast. The key activities in monitoring and comparing, we have KPIs, that's identifying the most important financial metrics to track. That's like revenue growth rate, profit margin, cash flow, customers, acquisition costs. Regular reporting, that's generate financial reports on a timely basis. Variance analysis, that's compare actual results to your projections and identify significant differences. Investigate variances, that's understand the reasons behind the variance. Are they due to internal factors? That's unexpected costs, sales performance, or external factor that's market changes. You want to take corrective action that's based on the analysis of variance, make necessary adjustments to your strategies, operation, or financial plans. And last would be regularly review and update the financial plan. The financial plan is not a static document. It should be reviewed and updated periodically, at least annually or more frequently if there are significant changes in the business or market. It has to reflect actual performance and evolving circumstances. As to why it's essential for monitoring and comparing allows you to track progress towards your financial goals, identify potential problems early on, make informed decisions and adjustments, hold yourself and your teams accountable, and improve the accuracy of future financial projections. By following these four steps, businesses can create a robust and dynamic financial plan that serves as a valuable tool for guiding their financial futures and achieving their strategic objectives. This slide focuses on the investment as a strategy for a business to grow its financial resources and manage risk. It outlines two key aspects: identifying investment opportunities and diversifying investments. Let's break down each of these in detail. For the identify investment opportunities, on the bullet point, research how the companies may invest excess earnings for either business growth, equipment or technology, or outside investment if funds are not needed for short to long term needs. Excess earning, and this refers to profit or cash flow that are not immediately required for the company's day to day operations, debt repayment, or planned short to long term expenses. For the part of investment for business growth, investing excess earnings back into the business itself can fuel growth and improve efficiency. And these examples include equipment, technology, research and development, marketing and sales initiatives, and training and development. When I said about the outside investment, meaning if the company has funds that are not needed for its eternal growth or immediate operational needs, it can consider investing in external assets. And these could include stocks and bonds, mutual funds and exchange traded funds, real estate, or other businesses. You want to consider the time horizon. This decision between internal and external investment and the types of external investment chosen should align with the company's short to long term financial needs and goals. Funds need in the near future might be kept in more liquid and less risky investments. On to the next bullet point we have is consider maintaining a business reserve fund. The purpose is a business reserve funds is a pool of liquid assets, and that's typically cash or highly liquid investments set aside to cover unexpected expenses, economic downturns, or sudden opportunities. The point of it is that having a reserve funds provide a financial safety net, allowing the business to weather unforeseen challenges without disrupting operations or taking on expensive debt. This fund is typically built up over time from excess earnings. The key characteristics of a reserve fund is its accessibility. It should be easily convertible to cash when needed. So on to diversify investments to manage risk. On the bullet point says allocate initial reserve funds in a bank or mutual funds money market accounts. Now paying up to 5% and other excess funds into a diversified portfolio. What I mean by diversification, this is a fundamental principle of investment management. It involves spreading investments across different asset classes, industries, and geographic regions to reduce the overall risk of the portfolio. The idea is that one investment performs poorly, others may perform well, offsetting the losses. When I meant by initial reserve funds, this slide suggests keeping the initial portion of the business reserve funds in low risk, highly liquid accounts such as bank accounts and mutual fund money market accounts. When talking about other excessive funds into a diversified portfolio, for funds that are not part of the immediate reserve and are not intended for longer term growth, the slide recommends creating a diversified portfolio, and this could include a mix of stocks, bonds, other asset classes. For managing a diversified portfolio, a business might choose to work with financial advisors or investment managers who have the expertise to select and allocate assets appropriately. Here, we have provide specific considerations for businesses when making investment decisions. It builds upon the previous slide by offering practical points to evaluate potential investments. So let's break it down to each point. We have companies' growth opportunities if certain investments are made. This point emphasizes the strategic alignment of investments with the overall growth objectives of the company. Before investing, businesses should carefully analyze how the investment will contribute to expansion, increase market shares, new product development, or enhance operational capabilities. The key consideration here is the return on investments in terms of strategic growth. Will this investment position of the company for a more successful future? So, on to inventory purchases of supplies and products that are in demand. While often categorized as operational expenses, strategic inventory management can also be viewed as an investment. Holding a sufficient inventory of in demand supplies and products ensure the companies can meet customers' needs promptly, avoid stockouts, and maintain smooth operations. The importance of it be meeting customers' demand, avoid lost sales, and optimizing production. The consideration of that is demand forecasting, storage costs, and just-in-time inventory. Investing in inventory of high-demand items is essentially an investment in meeting customer needs and ensuring sales continually. On to the next point, we have whether the anticipated investment return is above the cost of goods plus overhead expenses plus direct costs plus minimum profit margin. This point highlights the fundamental principle of probability for investment. Before committing capital, businesses can rigorously analyze the potential financial returns and ensure they all exceeded all associated costs, including a desired minimum profit margin. Any potential investments should be projected to generate revenues that, after deducting all relevant costs, still leave a profit margin that meets or exceeds the company's minimum requirements. This ensures the investment is financially sound and contributes positively to the bottom line. On to the last bullet point, we have retirement accounts contribute to owners' retirement accounts like 401k or IRA for long term wealth accumulation. This point shifts the focus on the personal financial well being of the business owners. Contributing to retirement accounts is a crucial long term investment strategy for the owners themselves. The benefit of this would be tax advantages, long term wealth buildings, and financial security. While these are personal investments, a financially secure owner is often better positioned to make better business decisions. Furthermore, for certain business structures, contribution to owner retirement accounts can have tax implications for the business itself. In essence, this slide provides a set of key considerations that business should keep in mind when evaluating potential investment opportunities, whether those investments are aimed at growing the company, managing inventory effectively, ensuring profitability, or securing the long-term financial future of the business owner. Each point emphasizes a different but equally important aspect of making sound investment decisions. This slide focuses on the debt management, a critical aspect of a business financial health. Let's explore each of the details. We have evaluate existing debts. Here we got assess outstanding loans and credit card balances, including interest rates and repayment terms. This first step involves a thorough inventory of all the debts of the business currently holds. This includes loans, credit card balances, line of credit, and other liabilities. Understanding the specific of each debt is critical for prioritizing repayments and developing an effective debt reduction strategy. We got identify which debts are high interest and prioritize them for early repayment. Meaning, once you have a clear picture of all your debts, the next critical step is to identify those with the highest interest rates. High interest debts can be very costly over time as a larger portion of your repayments goes through towards interest rather than reducing the principal balance. Debts with the highest interest rate should generally be prioritized for early or accelerated repayments. This strategy can save the business significant amount of money in interest expenses over the long run. To give that example, if a business has a term loan of at 6% interest and a credit card balance at 18% interest, the credit card debt should likely be the priority for aggression repayment. Now let's get on to develop a plan to reduce and manage debt. We have create a debt repayment strategy by allocating a certain percentage of monthly income towards paying off debts. And this involves making a conscious decision to dedicate a specific portion of the business regular income to debt repayment beyond the minimum requirement repayments. The percentage will depend on the business cash flow, profitability, and overall financial goals. It should be a sustainable amount that allows the business to meet its other obligations while making meaningful progress on debt reduction. This step often involves careful budgeting to identify areas where expenses can be reduced to free up more funds for debt repayments. The key to success with this strategy is consistency. Regularly allocating the determined percentage of income towards debt will gradually reduce the outstanding balances. On to the next bullet point. Consider using the debt snowball or debt avalanche method to systematically pay off debts. When talking about the debt snowball method, this method focuses on psychological wins. You list all your debts from smallest balance to largest, regardless of interest rate. You make minimum payments on all debts except the smaller ones, where you put in extra money. Once the smallest debt is paid off, you take the money you were paying on it and add it to the minimum payment of the next smallest debt, and so on, creating a snowball effect of increasing payment amounts. This method can provide quick wins and boost motivation. When talk about debt avalanche method, this method is mathematically more efficient. You list all of your debts from highest interest rates to lowest. You make minimum payments on all debts except the ones with the highest interest rate, where you put in extra money. Once the highest interest debt is paid off, you move on to the debt with the next highest interest rate, and so forth. This method saves the most money on interest in the long run because you're tackling the most expensive debt first. When it comes to choosing a method, the best method depends on the business financial situations and psychological preferences. The debt avalanche saves more money, while the debt snowball can provide more immediate positive reinforcement. On to the last part, we have prioritize high interest debt for early repayment. It emphasizes that not all debt is created equal, and focusing on the most expensive debt first can lead to significant long term savings. On to focus on paying off credit card balance with high interest rate first, as they can accumulate significant interest charges over time. Credit cards often carry some of the highest interest rates compared to other forms of debt like term loans or mortgages. These high rates means that outstanding balances can occur substantial interest charges quickly, making it harder to pay down the principal and increasing the overall cost of borrowing. Get that example, a business with a $10,000 credit card balance at an 18% annual interest rate will incur $1,800 in interest in just 1 year. if only minimum payments are made. By focusing on paying this down aggressively, the business can avoid a significant portion of these interest charges. For the strategic importance, prioritize high interest credit card debt can free up cash flow more quickly in the long run, as less money is being spent on interest payments. On to the last bullet point, we have once high interest debts are paid off, allocate additional funds toward tackling other debts. We have like a step by step approach, and this provides a clear action plan. 1. Identify high interest debt. As discussed in the previous slide, the first step is to identify all debts and determine which one have the highest interest rates. Credit cards are often at the top of the list. 2. Aggressive repayments. Focus any extra funds beyond the minimum payment towards paying down the principal of the highest interest debt. 3. Eliminate high interest debt. Continue making extra payments until the high interest debt is completely paid off. 4. Shift focus. Once the most expensive debt is eliminated, redirect the funds that were being used for its aggressive repayments towards the debt with the next highest interest rate, or the next smallest balance if following the snowball method for psychological wins. And 5. Repeat. That means continue the process until all debts are paid off. As for our last agenda, we have plan for financial uncertainties and overcoming barriers. Do you want to have a plan for financial uncertainties? For one, you want to anticipate potential risks and challenges that identify potential financial risk and uncertainties that could impact the business financial stability and performance. As for common financial uncertainties, that include economic downturns, market volatility, changes in regulations, and unexpected expenses. For established emergency funds for unexpected expenses, you want to set aside reserves for emergency funds to cover unexpected expenses or revenue shortfalls. You want to aim to build an emergency fund equivalent to several months' worth of operating expenses to provide a financial buffer during challenging times. You want to consider insurance options for business continuity that evaluate insurance policies such as property insurance, liability insurance, business interruption insurance, and key person insurance to mitigate financial risk. And you want to ensure that insurance coverage aligns with the business specific needs and potential vulnerabilities. Now, let me introduce you to a valuable resource called Evergreen B-Link that provides instant access to many non-cost offerings of assistance to new or existing small enterprise anywhere in Washington State. Created a few years ago by the Washington State Micro Enterprise Association, this link allows you to search by zip code, type of assistance, stage of your business, language support, and industry sector. Once you complete the search criteria, the link provides information on agencies or nonprofits' websites and location of business support service. I suggest you to try this link anytime, even before you might need specialized assistance, just to see what is offered and contact information on service providers. This is a free tool accessible to anyone with internet access thanks to our sponsors, the Washington State Micro Enterprise Association. Business owners can use the three main financial statements: 1. Balance sheet, 2. Income statements, and 3. Cash flow statements to both track progress and prepare financial goals for their enterprise. The important element of the balance sheet are: 1. Cash on hand in bank or other demand deposit accounts, 2. Cash set aside for investments that earn interest, dividend, or otherwise appreciate in value, such as holding some funds in stock market accounts. 3. Value of accounts receivable, which you want to collect in a short period of time. 4. Value of equipment and fixed assets, such as facility improvement, which are used to generate business revenues. 5. Accounts payable, money that you owe to suppliers and others. 6. Loans payable, both short term loans, such as a bank of line of credit, and long term loans, which are loans due within 1 year or longer. 7. Retained earnings, the amount of previous profits reinvested back into the company. For instance, after making a $50,000 profit at the end of the fiscal year, the owner leaves these funds in the business, adding to the retained earnings of the company. And 8, owner's equity, which are funds invested into the business by the owner of the company, usually expecting in the future to convert their equity investment into dividend payments or a profit from sales of the company's stock. Now, let's use some examples in setting financial goals. First, say you've been borrowing and paying interest on a bank of line of credit because you haven't been able to rapidly collect funds from buyers of your product. One solution is to build up a sufficient cash cushion to replace the interest bearing line of credit with eternal business cash. You still want to explore faster methods of collecting money from customer sales, but you will not be paying interest on line of credit loans. So, a financial goal might be to gradually raise the cash on hand of the business to substitute for the normal amount of cash account receivable due within 1 month. Another balance sheet financial goal may be to improve the display and counter areas of the business to be more attractive to customers, which may cost $20,000 in facility improvements. These facility costs are not an operating expense on the balance sheet, but listed as an asset, which is depreciated over the life of the improvements. This method of accounting allows the company to fuel revenue growth annually while limiting the expense of the facility improvement over 10 to 15 years. And let's consider a financial goal to be increase in retained earnings. This shows confidence that the business can produce more profits with net income reinvested. The owner will have the financial freedom to expand, decrease borrowing, or start an investment account that may be later be used for strategic investment or expenditures that may include an owner's 401k. Now, let's evaluate using the income statements to set financial goals. The income statement consists of revenues earned, expenditures, and profits generated by the company. Consider methods of increasing revenues, decreasing expenses, while also improving both total profits and your profit margin, which is usually a percentage amount based upon total sales. For example, if you had $100,000 of revenues in a fiscal year and earn $15,000 in profit, your profit margin is 50%, usually a positive rate for a business as long as pre-profit expenses cover all other costs, including payments to the proprietor. So you may want to think the ways to increase the profit margin by expanding online sales, searching for the best supplies at the most affordable cost, and negotiating lower premiums with your insurance broker. Sometimes you may need to actually increase expenses to increase both revenue and profit margins, such as investing in new technology that allows employees to be more efficient in the workplace. Often not considered is the cash flow statements, which separates paper money, which may include revenues not yet received as cash, but actual cash receipts and cash payments. The company's cash flow is an important monitoring tool to identify if accounts receivables are increasing, if outstanding credit card debts or payroll liabilities will affect future cash flows, or if investment accounts are available for short term uses. To illustrate, let's use the incubator statements of cash flow for the fiscal year ending June 30th, 2024, compared to the previous fiscal year. Note at the top of that, the incubator earned $315,000 during the recent fiscal year. That is the accrual counting amount, considering all funds earned and all expenses incurred, whether or not actually cash was received or paid. Note, immediately under net cash provided by operations includes account receivable of $34,000, which has yet to be paid to the incubator. So this $34,000 is subtracted from the incubator's net income since the cash flow statements only consider cash actually received. Next, see that incubators release cash by accounting for $11,500 of bad debt in its judgment account and $1,650 in prepaid expenses. Then note that 3 investment accounts totaling about $290,000 are also subtracted from cash available. This is because the incubator placed restrictions on the use of these investment funds and therefore are not readily available as cash. While these investment restrictions appeared as a negative in the cash flow statement, these funds will appear as a positive on a balance sheet. The difference is whether the funds are readily available as cash. Next, see that accounts payable funds due to vendors is $5,000 less than the previous fiscal year, and accrued payable, that's funds due to employer taxes or employees' benefits, are $8,000 less than the previous year. These accounts free up a bit over $13,000 more in available cash at the end of the previous fiscal year. After accounting for payroll liabilities and equipment purchase, note that the net cash increase for the fiscal year period is $18,400. That means that while the incubators earned $315,000 of net income using accrual accounting, $18,400 is actually available at the end of the fiscal year. While there were a number of cash flow adjustments, the difference is just about the $290,000 the incubator set aside as restricted funds for its investment accounts. At the bottom of this cash flow report is the $192,963 of cash available at the bottom of the fiscal year, while adding the new $18,400 in cash from operations during the fiscal year. The bottom line is $211,364 in cash is available at the end of the fiscal year. So a modest but desirable increase was made in cash holding of the incubator. Financial statements can be summarized or complex, but financial statements, including the balance sheet, income statements, and statement of cash flows, are vital assessments of any business enterprise. Each has unique aspects that grade the company's performance, such as your retained earnings, profit margins, and cash on hand. Our guidance is to use your financial statements both to assess performance and to importantly set and achieve goals that are valuable for the business. To let you all know that the next session will be the last one, and we'll talk about revisit your business canvas model. So that's it for this training session. Thank you for watching, and please subscribe to us here at William Factory for more videos on how to launch and grow your business. You can also find us on LinkedIn, Facebook, and Instagram. Don't leave your financial future to chance. Start charting your pathway to success today. This series is made possible with a grant from the Washington State Micro Enterprise Association. Thank you.